Imagine waking up one morning, checking your bank account, and realizing your home, the biggest investment of your life, is now worth less than what you owe on it. Not because you made a bad decision, not because you overspent, but because the entire system quietly shifted while no one was paying attention. This isn't a dramatic fantasy. This isn't YouTube clickbait. This is already happening across the UK. And the most dangerous part, the real data behind it, isn't what the headlines are showing you. Every day, newspapers push the same comforting narrative: house prices stabilizing, market showing resilience, soft landing underway. But behind that polished language lies a darker reality. A slow, structural unwinding of a property market that has been artificially inflated for over 2 decades. A collapse that doesn't scream, it whispers. And most people are walking straight into it. We're exposing the numbers no one is connecting, the trends no politician wants to highlight, the silent pressure building beneath Britain's housing market that could change everything for homeowners, renters, investors, and future generations. This is the real data behind the UK property crash no one's talking about. Let's start with what you're being told. Mainstream reports celebrate minor monthly price increases as signs of recovery. When prices fall by 1% but rise slightly the next month, it's framed as confidence returning. But this is statistical theatre. Real data tells a different story.
When adjusted for inflation, UK house prices have already experienced one of the sharpest real-term declines since the 1990s crash. On paper, it looks modest. In reality, purchasing power is collapsing. Wages are not keeping up, mortgage costs are not relaxing, and demand is weakening under the surface. The problem isn't just price, it's affordability, and affordability is the true heartbeat of any housing market. Right now, the average UK home costs over 8.5 times the average salary. Historically, a sustainable ratio is closer to 4 or 5 times. That gap isn't a warning sign, it's a structural fault line, and fault lines eventually break. Now consider the quiet crisis approaching millions of households. Between now and the next few years, over 1 million fixed-rate mortgages are set to expire. These were locked in during the era of ultra-low interest rates. Today, new mortgage rates are dramatically higher. For the average borrower, that shift means hundreds of pounds more every single month. That's not a small adjustment. That's the equivalent of losing a second income for many families. Parents cutting back on groceries, families cancelling holidays, couples delaying children, individuals taking on second jobs just to keep the same roof over their heads. But what happens when the numbers no longer stretch? Default doesn't happen instantly, it creeps in. Missed payments, negotiated extensions, debt consolidations, and then stressed sales. Not dramatic reposition waves, but a steady drip of forced sellers bleeding into the market. More supply, less demand, falling prices. That's not speculation, that's mathematics. Here's another truth rarely discussed. The UK isn't just facing a demand problem, it's heading toward an oversupply shock in key regions. Developers rushed to complete projects during the post-pandemic boom. High-rise flats, build-to-rent schemes, massive housing estates. But buyer appetite has cooled faster than construction pipelines can pause.
In many cities, listings are sitting longer. Prices are being reduced. Properties are returning to the market unsold. And landlords are being squeezed from every direction. Mortgage costs rising, new legislation tightening, tax relief shrinking, rental yield stagnating. So what do investors do when property stops behaving like an asset and starts acting like a liability? They exit. And when investors exit en masse, prices don't plateau, they slide. As landlords leave, rents rise, pushing more people into long-term renting.
But higher rents reduce the ability to save for deposits. That delays first-time buying. That weakens demand further down the line. It's a feedback loop that benefits volatility, not stability. Millennials and Gen Z face a housing reality their parents never experienced. The average deposit for a first-time buyer is now a life-changing sum. Owning a home is no longer a milestone. It's a privilege passed down or financed by lifelong debt. And here's what few admit clearly: future demand is shrinking. Delays in home ownership reduce lifetime market participation. The engine that once powered the UK housing market is being starved. Markets don't crash only because of numbers. They crash because of belief. For years, property was seen as a guaranteed win. Buy, hold, profit. But people are starting to question that belief now. Is buying even worth it? Why commit to decades of debt? What if prices fall after purchase? When hesitancy creeps in, transaction volumes drop. When volumes drop, price discovery falters. When price discovery falters, volatility rises. And volatility is where crashes are born. UK housing does not exist in isolation. Global inflation, central bank policy, international capital flows, and geopolitical instability all feed directly into mortgage rates and investor confidence. The era of cheap money is over. Liquidity is tightening. And every historic UK housing crash followed a period like this.
The difference this time is scale. Prices started at extreme levels, which means even modest price declines erase enormous wealth. Mortgage approvals are declining, listing reductions are increasing, selling times are lengthening, incentives are creeping back into deal structures. But the language remains soft: cooling market, adjustment phase, stabilisation. Words designed to cushion reality while value erodes quietly beneath. Now we move deeper into what the commentators refuse to explore. Transaction volumes are falling. Fewer sales mean more distorted pricing data. A thin market is fragile, and fragile markets don't hold under pressure. Interest rates are not abstract, they shape behavior. An entire generation was conditioned to believe borrowing was painless. That illusion is cracking. Even if rates soften slightly, the era of ultra-cheap debt is unlikely to return. The property model that depended on it is now obsolete, and obsolete systems do not age gracefully. Negative equity is no longer a theoretical risk. It is a looming reality for many. When a home is worth less than the loan against it, movement stops, investment stops, the chain locks up, economic drag follows, and this time exposure is larger than ever before. Small landlords are quietly selling, not loudly, just steadily. This flood concentrates ownership further while weakening price support. At the same time, banks are tightening lending. Higher deposits, stricter checks, reduced loan-to-income ratios. Every restriction reduces demand. Every reduction pushes prices lower. Politicians will never openly confirm a property correction. Housing confidence underpins consumer spending and voter psychology. So they project calm. But reassurance doesn't remove gravity. It only delays recognition of the fall. Real prices are increasingly separated from listing prices. Negotiation margins widen, incentives return. And when sellers start sweetening deals aggressively, it is not strength, it is survival behavior. Not all regions will fall equally. Some will stabilize earlier, others will absorb sharper shocks. But the national trajectory remains clear, rebalancing downward. Every crash follows the same emotional pattern: denial, rationalization, concern, acceptance, panic, opportunity. The UK is moving through the middle stages now, and history shows every correction feels impossible before it feels inevitable. Smart money moves early. Institutions follow probability, not emotion, and probability suggests the UK housing market is stretched far beyond sustainable income growth. That imbalance always corrects. For homeowners, response matters. Panic is not a strategy, preparation is. Understanding your exposure, stress testing your finances, building buffers. For renters, knowledge creates leverage. Tracking market reductions, watching shifts. For buyers, patience may be the most powerful financial tool available. Property corrections reshape society. They redefine expectations. They recalibrate belief systems. The myth of guaranteed appreciation weakens, and a more balanced reality takes its place. This isn't about fear. It's about foresight. Crashes punish ignorance, not awareness. Advantage belongs to those who see the shift before it becomes consensus. Your home is emotional. It holds memory, safety, identity, which is why downturns feel personal. But understanding builds armor. The market will move with or without your permission. The only choice is whether you are prepared when it does. So when headlines say the market is stabilizing, ask yourself, stabilizing for who, at what cost, and on whose timeline? Because behind the calm language, the data tells a different story. A story of quiet correction, slow exposure, and a generational turning point. And now, you are no longer watching blindly. You are watching informed. You are watching prepared. You are watching ahead of the curve.